You're listening to the Sound Money podcast of my show, covering the spread on 91.5 WNYE New York. For more news and headlines, as well as our latest interviews, you can visit our website at coveringdelta.com. Joining us now is Mish Shedlock of Sitka Pacific Capital and author of globaleconomicanalysis.blogspot.com, one of the top financial blogs on the internet today, and a great place to stay up to date on the latest in precious metals, interest rates, monetary policy, and the fiscal problems facing sovereign nations around the world. So, Mish, one of the questions that we posed to Gerald Celente in our previous segment was whether or not he saw inflation as a major issue going forward, particularly in light of ending QE2. You were one of the few people who recognized as early as 2008 that the real threat on the horizon was not inflation, but rather deflation, and you pointed to the importance of the breakdown in the money multiplier in support of this argument. Can you briefly explain to our audience the significance of fractional reserve lending insofar as the broader money supply is concerned, and why the massive increase in the adjusted monetary base does not necessarily translate into inflation as most people conceive of it?
Actually, it is, before we can begin to answer those questions, we have to step back and say, what is the definition of inflation and deflation? And there's a lot of competing arguments out there, and depending upon definitions out there, and depending on what definition someone picks, depends on whether or not one can say one is in deflation or in inflation or likely to head there. The definition that I use is inflation is an increase of money supply and credit, and I think it's important to mark credit to market. Deflation is the opposite of that. Deflation is a contraction in money supply and credit, again with credit mark to market. So I was calling for deflation, actually, it was probably as early as 2005, 2006. I saw that we were going to have a huge crash in debt, that money, that all these loans could not be paid back. Certainly that happened in the housing market. We saw people default on homes. We saw people default on credit card debt. And regardless of what prices do, in my model, if that defaulting of debt and walking away from mortgages exceeds the rate at which the Fed was printing, in my model, that says, we were in deflation. And we were in deflation by that definition. Certainly we were in deflation when one looks at prices of assets, not just prices of consumer goods. Home prices were falling, commodity prices were falling as well, but prices in food in the grocery store were not falling. Now, if someone says that inflation equates to prices, one can say, consumer prices, not just the prices of assets, one can say we were never in inflation. That's a poor way of looking at things, though. Look at the state of Japan for the last 25 years. And if you want to say, okay, based off of prices, which, barely fell in a number of years, and most years didn't fall at all, so Japan never went through inflation. But if one looks at it in terms of the aspect of what the destruction of debt on the balance sheets of banks, what the destruction of debt, what the value of debt on the zombie banks of Japan, and likewise in the United States, the effect of the zombie debt on the balance sheets of banks now have made it such that banks are capital impaired and they can't lend. So that's how I view this inflation deflation debate. And people always say Mish has been dead wrong on inflation. Look at all of these prices. He ignores all of this. Well, I think the proper definition is the one that I gave. Certainly look at the impact that we've had of that destruction of debt on the balance sheets of banks and what it's meant, for lending, what it's meant to asset prices. And certainly the Fed did manage to reverse that starting in March of 2009 when they flooded the market with liquidity. The value of debt on the balance sheets of banks rose. The financial markets inflated, but they never fixed the real economy. Unemployment rates still 8.9% if you believe the Fed. If you believe the Bureau of Labor Statistics, the BLS. Actually, if you factor in all the people that dropped out of the workforce, unemployment would really be 12% now. So they fixed the financial market, and because of that, one can say that we're in inflation now, but they've not fixed the real economy, and I think we're going to see a relapse on the debt aspect.
So for people that often hear money and credit thrown around like that, can you explain why in a fiat money system, money actually equals credit, which equals debt, and a contraction in lending can actually be a contraction in the money supply, just like an expansion of credit in the economy expands demand deposits, expands the money supply?
Well, I do make a distinction between credit and actual money. You know, if you look at money supply, and again, there's a bunch of competing measures out there. The Austrians have come up with something called Austrian money supply, which is, kind of a measure of the amount of money that's in checking accounts, money that's available on demand, kind of construct, and actually compare that to the amount of credit that's on the books of banks. One dwarfs the other, and certainly the Fed has come in and stepped up base money supply, but all of that money is just sitting there as excess reserves on the banks. This is where the argument comes in. The inflationists say, "My God, look at all of this money that's sitting out there as excess reserves." This money is just waiting to come into the market. It's going to drive prices up further and higher than anyone thinks, and some people even believe that the amount of money that the Fed is printing here is tantamount to hyperinflation. Well, hyperinflation is actually a complete loss of faith in currency. So this has nothing to do with the situation in Zimbabwe or in Weimar Republic. That money's sitting there as excess reserves. Now, the argument that I put forth, and actually it came from Steve Keen, and a very highly regarded economist in Australia, he says, well, all these people are wrong about what these excess reserves means. He says lending actually comes first and reserves come second. And if we think about that, we see that that's true. Fannie Mae went out there and created all of this, pseudo money by lending money to people for houses. That money was redeposited back in banks. But now, when the value of the loans crashed, what did the Fed do? The Fed stepped up this money supply. It's sitting there allegedly as excess reserves, but actually that money's needed because banks still have commercial real estate losses that are coming. Banks have residential mortgage losses that are coming. Banks have credit card debt that's going to be defaulted on as soon as the economy relapses again. Already credit card debts defaults still are very high. So all of these excess reserves that people look at, they're just really accounting for, all of these, this pullback in credit and this pullback in more defaults in mortgages that's about to come by. There's no excess reserves at all. How can there be excess reserves when money supply is dwarfed by the amount of credit? So, Bernanke's trying to overcome that, and the problem with inflationists, and especially the hyperinflationists, is they don't understand the difference between money supply and credit. They look at this monetary aspect of what the Fed's printing, but it's nowhere near approaching. We got $40 trillion worth of debt out there. The excess reserves on the balance sheets of banks, several trillion. So we are literally light years away from anything that on this kind of basis, one can say is inflationary, hyperinflationary. The Fed did manage, however, by pumping up all this liquidity to change the sentiment out of the market. And so we've seen the value of debt soar on the books of banks. Certainly we've bailed out the banks at the expense of taxpayers. So we've seen this lifting of financial assets, but how long can that last when the real economy did not follow?
So if I understand you correctly, you're saying that the distortion is that the reserves that are actually on bank balance sheets that people think of as money are really liabilities. Someone else's liabilities, not the banks, but someone else's liabilities, which are, in the case of mortgages, for example, not being paid down in the way that they're expected to, which is the whole mark-to-market and mark-to-model issue.
Absolutely. That's absolutely correct.
So what do you say to people like John Williams? They believe in the hyperinflation scenario. And in fact, John Williams admits that M3, the broader money supply, has been contracting year over year, but he still sees hyperinflation. And I think if I understand his argument correctly, he sees it coming from the foreign exchange market. He thinks that people are going to dump the dollar, which you just said you don't expect. He thinks people are going to dump the dollar, and effectively that's going to precipitate the hyperinflation. It's not going to be prices moving up in the economy, but rather a foreign exchange dumping of the U.S. dollar.
Dumping the dollar for what? Dumping the dollar for British pounds, dumping the dollar for the yen, dumping the dollar for the yuan. You know, if they're going to dump the dollar, what is it exactly they're going to dump the dollar for? Now, one maybe can make a case. I'm a gold advocate, by the way. I mean, you say, one can make the case they're going to, dump the dollar for gold or silver or things like that. But certainly that's not going to, impact the real economy and in any kind of hyperinflationary sense. So Williams is just extremely misguided. The British banks are in at least as bad a shape as the U.S. banks, and what people don't realize, for all this love affair of China, that if one's looking for inflation, one should look at China. The credit is expanding in China at 30% annual. Credit is expanding in the Credit is actually still contracting in the United States. We're in a period of inflation right now in my model because credit mark-to-market on the book balance sheets of banks has actually been restored. The bonds of some of the banks have risen to full market value. So we've restored confidence in the ability to for this debt to be repaid, but we've not restored the actual ability for it to be repaid. Nonetheless, my model says, okay, we're in a period of inflation now and have been roughly since March of 2009. But, take Japan, for instance. The U.S. has debt to GDP of about ratio of about 100%. Japan's is 200%. If Japan's would have trouble financing its debt if interest rates in Japan were to rise to a mere 3%. It would consume literally all of the revenues of Japan. Now, Japan has only been able to get by in the situation that it is, spending more money, because interest rates in Japan are at 1%. Long-term interest rates in Japan are at 1%. In the U.S., long-term interest rates are about 3.5% right now in the 10-year. 3.5% in Japan would wipe that country out. And if Japan started printing to pay off those notes that it owes the Japanese citizens, because they're the ones that finance this debt, hyperinflation, it would be far more likely to occur in Japan. Not that it's necessarily likely, but it's far more likely to occur in Japan because Japan is much closer to the edge than the United States is. So, Williams only looks at the U.S. in isolation. Other people make the same mistake. Peter Schiff makes the same mistake. They look and they say, my God, look, the U.S. is printing blah, blah, blah. They forget the fact that China is actually printing more. Great Britain is printing more. The European markets, while they're not printing more, they are still printing, and they've got other sovereign debt crises in Europe that the United States doesn't have. Certainly the problems in Greece, in Spain, in Ireland. I think Italy might be the next one where confidence is lost. So if we're talking about places where confidence is being lost, look at Japan. Look at Great Britain, look at those countries in Europe that I just mentioned, look at China, and so Williams is just way, way off base if he says everyone's going to dump the dollar. Dump the dollar for what?